Let me walk you through a situation that happens to millions of people every single month. You've been on top of your finances, you pay your bills, you watch your spending. Your credit score is in good shape. Then one month, life gets busy. You forget one credit card payment, just one. You might be thinking, okay, I'll just pay it next month. It can't be that bad. Here's what's actually happening behind the scenes while you wait. According to a LendingTree analysis of 100,000 credit reports published in January 2026, a single missed payment drops the average person's credit score by about 80 points. For someone with excellent credit, the drop can be 100 points or more. A score of 780 can fall to somewhere between 620 and 700 overnight. And that's just the beginning of the timeline. Today, we're walking through exactly what happens, hour by hour, day by day, when you miss a credit card payment. Because the consequences don't all arrive at once. They escalate. And knowing the exact timeline is the difference between catching this early and dealing with years of damage. First, a distinction most people miss. There's a difference between a late payment and a missed payment, and people use these terms interchangeably when they shouldn't. A late payment is when you pay after your due date but still within the same billing cycle. Say your bill was due March 15th and you paid on March 20th. You're late. Your issuer will likely charge you a fee. But here's the key. Your card issuer has not yet reported anything to the credit bureaus. Your credit score is untouched. This is your window to act. A missed payment is when a payment goes 30 days or more past due. That's when it officially gets reported to Equifax, Experian, and TransUnion, and that's when the real damage begins. Payment history makes up 35% of most FICO credit scores, the single largest factor in your entire credit profile. So missing a payment doesn't just cost you a fee. It hits the most important part of the number lenders use to decide whether to trust you with money and at what rate. Let's walk through exactly what happens at every stage. Stage 1, day 1 to day 29, the late fee window. The moment your payment deadline passes without at least the minimum amount received, your card issuer can charge a late fee. The typical credit card late fee currently runs around $30 to $35 as of 2026. A note on this. The CFPB attempted to cap late fees at $8 in a 2024 ruling. That rule was immediately challenged in court and remains in legal limbo as of 2026, with some major issuers having adopted the lower cap voluntarily, while others have not. Check your cardholder agreement for your specific issuer's current fee. A few other things happen in this window that people don't expect. Your grace period ends. If you normally pay in full and don't get charged interest on new purchases, that benefit disappears the moment you miss a payment. New purchases on your card now start accruing interest immediately, even if you pay everything off next month. If you had a 0% introductory APR offer, one of those deals where you're not paying interest for 12 or 18 months, missing a payment can end that promotion early. Some issuers revoke the introductory rate immediately, shifting your entire balance to the standard purchase APR, no second chances, no warning. And if you have rewards or cashback, some issuers freeze your access to points during the billing cycle, where the late payment occurred. The important thing about this stage, none of this has been reported to any credit bureau yet. Your credit score is still intact. This is your window, and it closes at 30 days. Stage 2, day 30, the credit bureau report. Credit card issuers wait 30 days past your due date before reporting a missed payment to the credit bureaus. The day that clock runs out, the delinquency is reported to all three, Equifax, Experian, and TransUnion, simultaneously. This is when your credit score takes a hit. LendingTree's January 2026 analysis found that the average credit score drop from a single missed payment is approximately 80 points. But the actual impact depends heavily on where your score started. If your starting score is around 780, a single missed payment might drop it to between 620 and 700, a loss of 80 to 160 points. If your starting score is around 680, the same missed payment might drop it to 600 to 640, a loss of 40 to 80 points. The reason the hit is harder for higher scores is that a missed payment is a bigger departure from the pattern. Someone with a 780 has a long, consistent history of on-time payments. One miss is a significant anomaly. The scoring model treats it accordingly. That late payment mark will stay on your credit report for 7 years from the date it was first reported. That's the bad news. The good news, the most severe score impact occurs in the first 12 months. By year 2, the effect has softened noticeably. By years 4 and 5, it has minimal practical impact on most lending decisions, assuming no additional late payments occur. What does a lower credit score actually cost you in real life? Here's what it can affect: loan approvals and the interest rate you're offered, credit card applications, apartment rental applications, and in some cases, auto insurance premiums. A lower credit score can impact the terms and rates on large purchases like mortgages and auto loans, meaning more money spent on every single payment. Stage 3, Day 60, the penalty, APR. If you still haven't made a payment by 60 days past due, most issuers can apply what's called a penalty APR, a significantly higher interest rate that kicks in as a punishment for ongoing delinquency. The penalty APR often hovers around 29.99%. To put that in context, if you were already carrying a balance at the average credit card rate of 22.15% as of Q2 2026 per Federal Reserve data, the penalty APR takes that even higher. Every dollar of your existing balance is now compounding at a faster rate. Bankrate federal law requires issuers to review your account after 6 consecutive months of on-time payments and potentially remove the penalty APR. But if you've continued to miss payments, that penalty APR can remain indefinitely. Your credit score also takes an additional hit at the 60-day mark, as a second delinquency is reported to the bureaus. The damage is now compounding on 2 fronts: financially and credit score-wise. Collection calls may begin during this period. Issuers have internal collections departments that will start contacting you by phone, email, and mail, trying to recover the balance before it escalates further. Stage 4, Day 90 to 120, the collections escalation. After 90 days, creditors often begin the charge-off process, meaning the issuer writes the debt off internally as a loss. At 120 days or more past due, collection agencies may purchase your debt. Origin your account is likely to be closed at this stage. That closure itself affects your credit, reducing your total available credit and potentially increasing your credit utilization ratio, which is a separate factor in your credit score. If the issuer sells your debt to a third-party collection agency, that collection account now appears as a separate, additional negative mark on your credit report, on top of the original missed payment. So you now have 2 negative items, where there was originally 1. At 180 or more days past due, collection activity intensifies. Wage garnishment or bank account levies become legal possibilities, depending on your state and the amount owed. Stage 5, Day 180 plus, charge-off and serious collections. After 180 days, many accounts are formally charged off, the issuer writes the debt off as uncollectible, and the account is sent to collections. At that point, credit damage becomes severe. A charge-off is one of the most damaging entries that can appear on a credit report. It signals to every future lender that a creditor gave up trying to collect from you. That's a significant red flag for anyone evaluating your creditworthiness for a loan, a mortgage, a rental application, or even some employers who run credit checks. Stage 6, how to recover at each stage. Here's the practical part: what to actually do, depending on where you are. If you're in days 129, pay immediately, even if it's just the minimum. Call your issuer and ask them to waive the late fee, especially if this is your first offense and your account has a good history. If you're able to pay off your late statement balance entirely, that's the best outcome. Acting fast limits almost every consequence. If you've hit day 30 and the delinquency is reported, pay the full balance or minimum immediately to stop further escalation. The late mark is now on your report and will stay for 7 years, but paying now prevents it from becoming a 60-day, 90-day, or charge-off mark, which would each be additional hits. You can also write a goodwill letter to your issuer requesting removal of the late mark. There's no guarantee, but it works for some people with otherwise clean histories. If you're past day 60, pay what you can immediately and contact the issuer directly. Explain your situation. Many issuers would rather work out a payment plan than continue the collections process. Ask specifically about hardship programs. Going forward, set up autopay for at least the minimum payment amount. A failed autopay due to insufficient funds is still treated as a missed payment, so make sure the linked account has the funds and set a calendar reminder to check a few days before the due date. Let's look at 2 people who both miss the same payment and what happens based on when they catch it. Meet Priya and Daniel. Both have a credit card with a $3,000 balance at a 22.15% APR. Both miss their payment due on April 1st. Priya realizes on April 18th, 17 days past due. She pays immediately. She's charged a late fee of $30. Her grace period resets next billing cycle. Her credit score, untouched. Total cost of the mistake, $30, which she gets waived by calling her issuer because it's her first late payment in 3 years. Total damage, 0. Daniel doesn't notice until May 10th, 39 days past due. He's past the 30-day mark. A 30-day late payment has already been reported to all 3 credit bureaus. His credit score drops 75 points, from 720 to 645. His issuer has assessed a $30 late fee, and his new purchases have been accruing interest since April 1st. He pays immediately once he notices, which stops further escalation. But the late payment mark stays on his report for 7 years. Over the next 12 months, he works to rebuild by paying on time every month. By month 12, the impact has softened significantly. By year 3, it barely registers in most lending decisions. Same starting balance, same missed payment. Priya caught it within 30 days and walked away with nothing. Daniel caught it on day 39 and spent the next 2 years rebuilding from a 75-point drop. The window between those two outcomes is 30 days, and most people don't know the clock is running. Days 129, late fee of roughly $30 $35 depending on your issuer. Grace period ends. Promotional APRs may be canceled. No credit bureau reporting yet. This is the window to fix it with no lasting damage. Day 30, reported to all 3 credit bureaus. Average credit score drop of approximately 80 points per LendingTree's January 2026 analysis. Mark stays on your report for 7 years. Day 60, penalty APR kicks in, often 29.99%. Second delinquency mark reported. Collections calls begin, days 90, 190. Charge-off process begins. Third-party collections possible. Account may be closed. Day 180 plus. Formal charge-off. Debt sold to collections. Wage garnishment possible. The earlier you act, the smaller the damage. The single most important thing you can do is pay something, anything, before that 30-day mark and call your issuer immediately. Have you ever missed a credit card payment, and did you catch it in time? Drop it in the comments. These real-life timelines are useful for everyone reading, and I genuinely like to know how common it is. Next video, we're tackling how mortgages are actually calculated, where your money really goes each month, why the early years of your mortgage are almost entirely interest, and what actually changes when you make an extra payment. Subscribe so you don't miss it.